Is yours loud? You can
It's loud.
you can adjust your.
Number three. Oh yeah. Okay. Is that better?
That's not me.
No, you're number two.
Number two.
Should be number two.
No. Well, I'm not. Sorry. I'm good. I think I'm
You're okay.
okay. Yeah.
We just won't yell too loud.
Everybody else okay?
Yep. Okay here. All right.
Okay, Panky.
Okay, here we go. Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host, Mark Hanf of Pacific Private Money and non-fan also of Pacific Private Money. Our phone number is 888-912-1190. You're going to use that number to answer the trivia questions for a 5-pack tanning certificate given away during the show. And the certificate is not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Now, and today's trivia theme, again, is random trivia. Now, today's show is going to be interesting because we're going to be talking about marketplace lending, and I want to find out why the audience should know about this, Mark.
So marketplace lending is a relatively new term, and if you're reading, the business section or any of the business periodicals that come out, you're seeing a lot of references to this thing called marketplace lending. And what exactly is it, and why should you, the consumer and the investor, care? Well, you really should care because it is a fast-growing segment of borrowing. And marketplace lending, essentially, it's previously been called peer-to-peer lending, and prior to that, it was called private lending, and prior to that, it was called hard money. So really, when you hear someone talk about marketplace lending today, what's happened with the advent of technology and improvements on the internet and financial service companies that have sprung up in the last several years, and most recently, thanks to the crowdfunding legislation that was passed in 2013, that created an explosion of companies that are online making loans to individuals using private capital. And so that's now being referred to in the industry as marketplace lending. But if you hear the term peer-to-peer lending or private lending, it's essentially the same thing. Now, we've talked on this show for years about private money real estate loans. That's something we specialize in at Pacific Private Money. But we've lately been using the term marketplace lending to describe Pacific Private Money in a more modern fashion to kind of compare and contrast ourselves with some of the marketplace lenders out there that are making consumer loans or auto leases or business loans. We're in the real estate loan business, and there are real estate loan lending marketplace lenders. So we refer to ourselves at Pacific Private Money as regional marketplace real estate lenders, because all we make are real estate loans. Now, why as an individual, as an investor out there, should you be aware of the marketplace lending industry and what's happening there? And the reason is because marketplace lending has now opened up the opportunity for individuals to participate in high-yield investments that previously were really only available to those who were the ultra-high net worth, who were those people who were in networks that allowed them to see and be exposed to investment opportunities, oftentimes private placement type opportunities where they can get high yields, sometimes as much as double digits, but certainly in the high 7s, 8s, and 9s are not unusual. And so now, through this new marketplace lending platform, including platforms that we have at Pacific Private Money, anyone who is who meets the term of and the qualification of being an accredited investor, and in the Bay Area, that's a fairly easy threshold to reach. You're talking about a $1 million net worth minimum. If you qualify as under that accredited investor definition, you now can go online and look at various investment opportunities from these marketplace lending platforms. Now, you can certainly go to Pacific Private Money and learn more about them. I'm not going to name off the competitors, so you can find those yourself. Later in the show, we're going to tell you why you need to be concerned and differentiate between different types of marketplace lenders, because they're not all created equal, and even the ones that are making real estate loans aren't necessarily offering you the same type of investment collateral and protection when you invest on their platform. So we'll talk a little bit more about that. But marketplace lending is it's exciting, it's growing, and it's really one of the other reasons it's growing. It's in response to the Dodd-Frank banking regulations that have made it more difficult for banks to make loans. And so whenever there's a void in the source of capital, demand certainly hasn't stopped. People need money. Businesses need money. Buyers of homes need money. Individual consumers need to borrow money from time to time. If the banks aren't making them the same way they used to, say, 10 years ago, where do you go from there? And so that crowdfunding act that was passed in 2013, making it easier to raise capital, now they're looking to lend out that capital through their platforms, and more individuals, businesses, consumers, real estate investors are going online as opposed to the bank because now you got things where you can get the loan faster than you can from a bank, or maybe you've got certain situations in your credit history or your job history or others that make you less attractive to banks. And that's really one of the areas where marketplace lending is really thriving. And certainly at Pacific Private Money, if you've listened to our show before, you'll recall that the reason we're in business today is because we specialize in fast, reliable capital for those looking to close a real estate transaction or to borrow equity from their home. The thing that banks can't compete with us on is our speed. We're very, very fast and very holistic in the way we look at that. So we'll continue to talk more about marketplace lending as the show progresses.
All right, we're going to cut to our first commercial break. And here is the trivia question. Which president accepted the Statue of Liberty on behalf of the American people? Good. I'll tell you a hint. It was not.
It was not Taft.
That's Mark's
That's
favorite.
always my answer.
It wasn't George Washington, and it wasn't Bill Clinton. Okay, those are the two hints you get.
And
You got about 45 more presidents to go. All right, call 888-912-1190, and the first caller with the correct answer is going to win the free Tan Bella tanning certificate, which is good for 5 tanning things. Okay. Here's a question. Which president accepted the Statue of Liberty on behalf of the American people? Don't touch that dial. The best of investing is going to be right back.
Other 43 presidents.
For 43, I can't remember how many total presidents there are.
So that was 7. Now we're going to the 828 or 830.
828.
Let's see. Segment 2. Nam, you want to jump in on a couple of things?
Yeah, maybe start with. I'll just add too that if they're searching for marketplace lenders, they'll also see alternative finance as another term too. And maybe we can expand on the regional versus national.
Good.
Perfect. So dive back into this. We're talking about marketplace lending on today's show. Nam, why don't you jump in? That's quick.
I do have a quick question on it about with the competition with the rate.
Oh yeah. Well, just maybe throw that in any time.
Okay.
Yeah.
Here we go. I'll let you answer that. Great. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hunt and Nam Fan of Pacific Private Money. Here was our first trivia question. Which president accepted the Statue of Liberty on behalf of the American people?
So bad with this.
Teddy Roosevelt?
No, Grover Cleveland. But I can't remember if it was his first or second presidency.
Grover
Okay.
Cleveland. He was the big guy, wasn't he?
Yeah, he was kind of big. Not as big as Taft, but he was big.
Is Taft really big?
He was like 300 and something pounds.
Oh,
Right? He goes out in history as the fattest president. Okay. And we've been talking about marketplace lending, and Dom, we're going to turn it over to you. And actually, I'm going to ask you this quick question. Do you think competition, because now you're going to have a lot more lenders out there theoretically with this marketplace lending, shouldn't that bring the interest rates down?
Yes and no. I would say, the more competition, obviously, entering the space, it should. You have more capital chasing fewer deals. There's a finite number of loans out there. So over time, you'll see some erosion of pricing to the benefit of the consumer. So great for the consumer, but it also depends on the kind of loans or loan product or borrower. So kind of going back to something Mark mentioned earlier, you've got a lot of marketplace lenders or also alternative finances, another term you'll hear that's interchangeable, who are national in scope. So they're providing loans across the country. In those scenarios, it's very hard to underwrite it at a distance. So the easier the type of loan product it is, the more vanilla, then the more competition will be chasing those, especially amongst these national lenders. For regional companies like ourselves who specialize in a market, oftentimes we're doing deals that the national lenders can't do, just because it takes a lot more due diligence, a lot more an understanding of the marketplace.
Yeah, I can imagine, a property in Kansas City is not the same as a property in San Francisco.
Absolutely, and that's why we won't lend really out of state. We know our market, and because of that, we're one of the few who can really underwrite a decision very quickly. That's one of the things we're known for.
Well, that's also why some of those companies that are out of state, they can't understand how the market value is here so high, and so they think it's ridiculous.
Yeah, and a lot of times they just won't touch those types of loans, and they'll send them to us. And with that expertise does come a little bit of a premium, but we decision very quickly.
And another point on that is a lot of these new alternative finance companies and marketplace lenders that have sprung up in the last few years, a lot of them are based here in the Bay Area. In fact, many of them are based in San Francisco. And from an investor standpoint, let's say I'm going to invest with a company that's an alternative real estate lender. They happen to be based in San Francisco. They're well known. They've got a shiny website. You go on there and you look at investment opportunities, and a lot of those are in other states. And so I always wonder, it's like, okay, well, what kind of expertise does a California-based tech lending company have on properties in Atlanta, Georgia, or in Texas, or in other states throughout America? And that's one of the things that it's a head scratcher for me, as the founder of Pacific Private Money, and over the past 10 years, is we really have always avoided areas within California that we just don't understand, that we just don't get, and we don't lend out of state. And so you just want to be wary when you're investing on a nationwide platform on these real estate deals, because I get a lot of these emails, these promotions from these companies, and I scroll down and I look at some of the offerings, and they say, oh, there's a piece of this loan available, and I just wonder, I would be nervous about that. So I think the regional aspect of what we do, I believe, adds another layer of, let's just say, safety and security features, because we kind of know and understand the market, and we're not the only ones. So not to say that Pacific Private Money, we're the only regional marketplace. Now there are actually really good companies within California and elsewhere, and I know many of the.
Well, you work with them.
We work with them.
You refer deals to them.
Yeah.
They refer
Yes, we do loans
you.
that they don't do. We do a lot of consumer lending, which a lot of other regional marketplace lenders do not do. They just love to fix and flip stuff.
Sometimes it depends on also who's got the money at the time.
Yeah,
right.
It's also interesting in California how much lower the interest rates are on loans on California properties versus other properties, and that's one of the reasons why some of the California-based lenders want to go out of state, because they can earn a higher return both for their investor clients and for themselves. Whereas California, there's more lenders, and it's one of the more sought after states to invest in. There's a lot of confidence in the real estate market in California. The job rate is unemployment rate is so low, and of course, if you're a real estate investor, you know that jobs and unemployment rates and job strength is a factor of real estate price strength and real estate price appreciation. So anyway, we've got lower interest rates in California, and that's something that we battle at Pacific Private Money, is that we see competitors driving rates down. But I have a feeling we've kind of seen we're getting close to the bottom, and the reason for that is because investors below a certain return aren't going to be interested in taking the added risk of investing with these alternative investment opportunities. Then they're probably going to say, well, if I'm only getting 5%, maybe I should just stick with the stock market or
bond market
or munis.
Well, one other thing that really isn't brought up in investing far out of state, like Indiana and all that, where I get the same kind of emails.
Indiana.
Yeah, and it's like wow, you can earn a good rate of return on this stuff. But
12% for
right.
loans in Indiana.
Yeah, or you can
Or
buy this
Ohio.
property and rent it out.
Michigan.
But what people don't really kind of go to the next step, which is when something goes wrong, not if, but when something goes wrong, now what am I going to do? Am I going to fly, to Indiana and try to figure out what to do, or just start dialing for dollars and, hey, are you a good realtor? Can I trust you to handle this for me, for this foreclosure? And, you got to know all the rules and all that. And it's just, if you got something in your backyard, then you could easily handle it.
Well, that brings up another point too. It's when you invest on these online marketplaces and you're approving or you're investing in a particular loan, you actually might not be investing in. You're not going to necessarily be named on that loan, and so there's this phenomenon known as platform notes that a lot of these companies are issuing. And so what that means is that you might be greenlighting your investment to go into this property, let's say in Texas, and you get you invest $5,000 of a $100,000 note. Well, if that thing goes into default, you don't necessarily have the right as an individual you don't have the same foreclosure rights, and so you really need to kind of understand what it means. Will the company guarantee your investment, or who's in charge? Basically, who's going to foreclose on that property? What does that mean to you?
And I guarantee there's going to be some companies out there that are going to be fraudulent. I guarantee it. I don't know which ones, and it's going to happen. Where you're part of this note. Well, turns out you're not part of the note. So for some reason, it's
right. The platform note issue is new and untested waters.
Exactly, and when that happens, all the little guys come out and the fraudulent stuff. I hate that stuff. Okay, that's why I like dealing with Pacific Private Money, because I can look you right in the face. All right, here's our second trivia question: what Southern politician was shot and paralyzed by Arthur Bremer on May 15th, 1972? All right, that's our question. What Southern politician was shot and paralyzed by Arthur Bremer on May 15th, 1972? Call 888-912-1190, and you'll win a prize if you're the first caller with the correct answer. Don't touch that dial. We'll be right back. Now this one you guys will know the answer to. All right.
Or not.
Or not.
I do.
See? You can answer that one.
No, I'm too young for that.
You're too young.
You weren't even born in 1972.
I remember when that was.
Actually, have you called the gym guys yet?
No, I haven't.
Okay.
I've got to use that. I won a trivia. I don't remember what
Yeah.
it might have been the question I came up with.
Yeah. I give it to you, but you already have a trainer, so you probably don't.
So we're going into three of essentially four main segments. Would this be a good one for email time?
Sure.
And then you can do deal of the week as well?
Yes.
I've got a deal of the week. That's divorcee at her job for only 11 months. Trying to buy a home.
Perfect.
2 strikes against her.
Yeah, really.
What would be the third?
This is going to be the hee-haw version, so it's deal ode a week.
Deal of the week. Hee-haw!
Now, I do remember Hee Haw.
You remember that?
Yeah.
Tell you, boy, those guys could really play. Big talented. Roy. I should say Roy Larson. Roy Mark. Buck Owens.
Buck Owens, that's right.
I've been to his place in Bakersfield, Buck Owens Center.
Oh, really?
Yeah, saw a show there.
Bakersfield. Wow.
You
You've
doing
been-
in Bakersfield?
You've been to Bakersfield?
Been there too many times.
It's like a Everybody Loves Raymond episode where Ray's mother-in-law, he's explaining where he does all this stuff, and he goes, so I was just in Tampa, doing blah, blah, blah. You've been to Tampa?
All right.
All right, here we go. Welcome back to the Best of Investing. Again, I'm Edward Brown, your host, along with Mark Hahn and Nam Fawn. It's Nam Fawn, isn't it?
It is.
Okay, I've been calling you Nam Fawn.
I know, I haven't said anything.
I know,
for-
and Mark had to remind me one time. It's like however you say Nam, you also say Fawn.
Thanks, Mark.
Yeah, so I got to remember that. I'm sorry.
It just came to you.
It did.
That's so
Actually.
funny.
Okay, here's our trivia question. What Southern politician was shot and paralyzed by Arthur Bremer in May of 1972?
Speaking of non-fun, he was too young
Yeah.
to remember that it was George Wallace.
That's right. Very good. Okay.
That name rings a bell.
Well, he wasn't elected president. I'll let me try.
He tried. That's right. Okay, so we were talking about marketplace lending. We're going to shoot right on over to email time. So, Mark, question comes in. Why should investors invest in the Pacific Private Money Fund versus something like a REIT?
Okay, so the Pacific Private Money Fund is a debt fund. It could be described similarly to like a mutual fund of real estate secured notes. Now, it's not a mutual fund. It is a private placement. We have a private placement memorandum. It's what's known in the industry as a 506 Reg D mortgage pool fund. And all of that funky naming notwithstanding, it's essentially a debt fund. And the fund is up to $30 million right now, and we've got about 86 loans in the fund, totaling $30 million.
And when you say a debt fund, you're investing
real estate
in
debt
mortgage.
fund, right?
Okay.
So the only thing that fund exists to do is to be a lender to supply the money for real estate loans that we originate at the brokerage of Pacific
So
Private
you're
Money.
like a bank.
Right, it's
Basically,
like a
acting
bank. So there's Pacific Private Money, which is a corporation. It's a brokerage licensed in California to originate loans. And the fund is a separate entity. It's an LLC. It's Pacific Private Money Fund, LLC. And the members of that fund are the people who contribute their capital. So it's owned by the investors, the people who put their money in. And we've got average investments as low as $50,000 all the way up to several people who are over $1 million. Actually, we've got a half a dozen investors in there that are between $1 and $2 million in investment, comprising that $30 million. So let's compare and contrast that to a REIT. So REITs are interesting in that, like stocks, they're publicly traded. And like stocks, the price goes up and the price can go down. The price can go below your investment price. That's something that is possible but not likely in the Pacific Private Money Fund because we make loans at no higher than 70% loan to value, and the weighted average loan to value in the fund is less than 60%. So unless we had a very horrific downturn once again in real estate, it's not likely that your invested dollar, your principal, is at risk. It would really mean, whether we're able to sustain the 7 3/4 to 8% return that we're creating right now through the fund. Now, in a REIT, so it's like a stock. It's publicly traded. The Pacific Private Money Fund is not publicly traded, so we have a 1-year minimum investment period. You can't treat it like a money market account until after you've been in a year. After a year, in theory, you could put money in, you could take money out, and people do. We redeem monies every month, but it's not designed to be a liquid fund. If all the money is lent out in the fund and you need your money out tomorrow, we may not be able to accommodate you. So you need to understand the liquidity issues of investing in a fund. But some funds, including ours, are designed to be liquid because we make short-term loans and we're always getting new invested capital. So we have not had an issue redeeming anyone's monies yet, even in an emergency.
Well, yeah, when a loan pays off, you first see if there's anybody who wants to get out,
right,
before you redeploy the money in a new loan.
That's exactly right.
So you don't have to just wait for new money to come in.
Right.
That may or may not come in.
Right. And so let's get back to a REIT again. So REITs are designed to distribute somewhere between 90 and 95% of their profit to the REIT shareholders. The challenge with that is how is that profit defined? So every REIT is different on how they define, what is profit, and so those distributions can and do vary quite a bit. And I know, Edward, you're fairly familiar with REITs. You once were in charge of a group that had to go in, I guess, and audit and wind down a REIT.
Well, what happened was that there was a $500 million REIT that used too much leverage, and when they went bankrupt, there were 29,000 shareholders, and I got appointed by the Department of Justice to be the chairman of the equity committee. So not of the company, but they had. Everyone was in their little camps, and I was supposed to protect the 29,000 shareholders. And I'll tell you, they raped and pillaged this thing, even in bankruptcy.
Do most REITs use debt, or is it different?
This one didn't have debt for a while, and then they started to leverage it. But most of them usually do use some debt.
Okay.
But again, the main question, like you brought up, is how do you define profit? Well, what if the guy running the REIT decides, we need all new furniture, or we need this, or we need that, and it hits the bottom line, and you're left with $500 left of profit. Oh, sure, we'll distribute 95%, but 95% of $500.
So if someone tells you should invest in a REIT because it has more, stock-like traits and is more liquid than, say, a private placement, one of the things you're going to want to investigate is that not all REITs are the same. Some use leverage and some don't. You want to look at their historical track record for distributions. I mean, there's a lot of variables. It's almost as variable as picking stocks themselves.
Well, that's true. And also, it really comes down to the expenses. Because, how many times have, you've seen situations where someone says, yeah, let's get into a deal, a partnership or something. And, they want you to be like a JV partner. And they say, and what we'll do is we'll split the profits some percentage, right? And the way I look at it is, no, I don't want to be your partner, because if you determine what the profits are, I don't know what kind of expenses you're going to throw in. I'd rather just say, no, I'm going to be a lender, and I'll have an exit fee or some, percentage of sale price, of the sale of the building.
Right.
So don't hear what I'm not saying. And we're not anti-REIT, just like we're not anti-stock. It's just that when someone says to you, for example, we had this situation come to our company recently where an investor said, hey, I went to this event and I talked to the person who was talking at this financial seminar about, have I gone off? Am I still hanging out?
Yeah, I can hear you.
Okay, good. And asked about mortgage pool funds, and the person who was the sponsor of that event said that they were not in favor of mortgage pool funds, that you should consider REITs instead. And so again, there's different, everyone has a different opinion in investing, and some believe you should have all your money in stocks and bonds and nothing in alternative investments, because alternative investments historically, they're not regulated the same way and they're not liquid the same way as stocks and bonds are. However, if you're nervous about the stock market, maybe you think it's a little on the high side right now and you wonder going forward, maybe you want to take some of your profits and redistribute that a little bit. Or if you're also nervous about REITs because it has stock market-like behaviors, take a look at alternative investments. At Pacific Private Money Fund, we just passed our 4-year anniversary. We have distributed at a 7.5% to 8% annualized rate, month in and month out, without fail for those 4 years. And yes, we're looking ahead and going, well, what about when the next cycle hits? Well, we've designed the fund to make short-term loans. And short-term real estate loans, by their nature, are generally, I won't say immune, but they're certainly less exposed to changes in the real estate cycle. So we're very bullish about our program, and please get a hold of us for more information at pacificprivatemoney.com. Go to pacificprivatemoney.com
or 415
883-2150.
I can just keep feeding you the answers. Okay, here's our next trivia question. Who was the father of Cleopatra's twins? Who was the father of Cleopatra's twins? 888-912-1190. Give us a call. Bye. 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 Okay. Bye-bye.
I know the answer.
There you go, okay.
What's his name, Mark?
Huh?
It was, yeah.
You do that. That's what I said you do, right?
You'll find out.
Ah, good, okay.
Well, I'll let you guess first, because I think I know.
Oh.
Especially this first.
Yul Brynner?
Yul Brynner. I didn't know she had twins.
I didn't either, but it's funny because it was.
So this is the last one, right? We're doing the 5
last. No, this is
The 9.
Oh, we're doing another 9. Okay, so
You can ask the other question.
And then we'll
to
do
me, I
deal of
guess.
the week. Yeah, I'll ask John the question, and then we'll go deal of the week.
okay, good.
Well, welcome back to the Best of Investing. One more time, I'm Edward Brown, your host, along with Mark Hoff and Nam Phan of Pacific Private Money. Here is our next trivia question. Who was the father of Cleopatra's twins?
Let me guess. If it was Cleopatra, so it was Mr. Patra. Is that right? Is that? You're not taking me very seriously here.
That's funny though. I like that.
So I'm wrong. I guess I'm wrong.
His
All
first
right.
name was
Well,
Mark.
Yes.
His
and what was the
second
last
name,
Anthony.
Anthony,
Mark Anthony.
Anthony, not
Anthony.
Anthony.
Antony. Okay, Mark
Antony, yeah,
Antony.
that's right.
Mark Antony.
Mr. Patrick, I like that. Yeah, Cleo was the first name, Patrick was the last name.
Right.
Very good, I
Yeah.
like that. Okay, so now we have a email question that came in that you can answer. It says, if I invest in the Pacific Private Money Fund, can I see where my money is going? So, like, what's the transparency of the fund?
Yeah, good question. So something that Mark mentioned earlier is the answer is yes. Investors can log into our investor portal, which is right on our website, and see every month the list of the most current loans in the fund. So the properties, the market values, the amount, the LTV.
And you can actually pull preliminary title reports and see that you really, that it's not like you just say that you have these investments.
Absolutely.
And there's online tools you can go to. It's everything from Zillow to Redfin and other places. You don't even have to actually go to a title company and pull a report now. There's online tools you can use to actually see valuations and potentially see market sales and debt.
Oh yeah, and you can see who's recorded on the.
From some web portals,
Yeah.
some real estate web
okay.
portals.
Oh,
Yeah.
very cool.
Right.
Okay.
And just to add to that too, something that Mark was talking about earlier, the industry has become much more transparent, which is great for the consumer. Marketplace lenders in general are really elevating the transparency. So it's becoming a much more, I guess, grown-up industry than what it was 10 or 15 years ago.
It may not be considered an alternative investment pretty soon.
Right. I mean,
right?
It's certainly not fair to compare it to mortgage pool funds and alternative investments from 10 or 15 years ago. And that's what upsets me when someone says, well, I knew someone who lost a lot of money in a mortgage pool fund, or I lost money in a mortgage pool fund. It's like the business model isn't even closely resemble what it did 15 years ago, before Dodd-Frank and before the demand for alternative finance has completely changed.
Well, and there was a time, and if I'm not mistaken, I think it was in the 70s, where people from the 60s lost a ton of money in REITs. And so REITs were completely out of favor.
Right.
It was like, I'll never
So is
invest
that a
in
reason
REITs
not
now.
to invest in a REIT today because in the 60s it was a terrible
Yeah.
investment?
But you know what? Guess what? The stock market crashed in July of 1987 also. But does that mean you should never buy another stock again? Yeah, probably not.
Right. Right. There's so much more information available to investors to make a sound decision, to do their due diligence. So going back to, our scenario, we provide the list of properties every month, and it's updated every month as loans pay off and as we add new ones to our fund.
And again, just before we go into the deal of the week, how do people get hold of you guys?
They can reach us at www.pacificprivatemoney.com, or they can call us at 415-883-2150.
Okay, so Mark, give us a deal of the week. Explain to the audience like what you guys do for a living.
So we're working on a deal this week, and just backing up a bit, talking more about why we're different, why marketplace lenders, why alternative finance companies are different today than they were 15 years ago, why a mortgage pool fund today is not likely similar to the ones that got in trouble 10, 15 years ago when the market changed. It's the nature of the type of loans that we're doing today versus what were being done in most mortgage pool funds 10, 15 years ago. 10, 15 years ago, banks were pretty much lending to everybody. That's how we got into trouble in 2008, that you could essentially get a loan simply by having a decent credit score. And your mortgage broker at the time would probably fill out the paperwork for you, put in a whole bunch of numbers that didn't make any sense, and you'd sign it and you'd get a loan. That doesn't happen anymore today. And so going back 15 years ago, as a result of the fact that most borrowers could get bank financing, the type of loans that alternative finance and mortgage pool funds were making were riskier type of loans. They were making land development loans and junior liens to people in financial distress. And so the quality of the loans in a typical portfolio were much, much different than they are today. They were riskier in nature. Fast forward, we're in 2017. What types of loans are in the Pacific Private Money Fund portfolio? They're mostly to people with credit scores above 700. They're mostly short-term loans to people who can qualify for bank financing, they just need more time. They're mostly to people who are buying, remodeling, and flipping properties, and they're not high LTV situations. We're not making risky land development loans, and we're not generally making seconds to people in financial distress because, quite frankly, we're not allowed to do so anymore under the Dodd-Frank predatory lending guidelines. So with that being said, let's talk about a typical loan situation that we're working on this week. We're working on the client is going through a divorce. It's a woman going through a divorce. She wants to buy her next home. And so she's got two strikes against her as far as the banks are concerned. One is she's going through a divorce, and that's uncertainty, and banks don't like that. Her bank told her that she needs to finalize the divorce before she'll qualify for a loan from them. The second thing is the job she's been at currently, she's been there for 11 months. That's just shy of what typical bank regulations require, a 12-month minimum job seasoning. A third strike, which she doesn't have, would be she's got to close next week. Well, in this situation, and that's typical for us too, we get a lot of deals where maybe everything else is perfect. You know, they've been at their job for a while, they're not self-employed, so they've got good W-2 income, they're not going through a divorce, they don't have any hiccups on their credit. In fact, we do a lot of loans to people with over 800 FICOs, and people go, well, why don't they just go to the banks? They get all like, defend, it's funny how people react that way to it. It's like, they can't go to the bank if they have to close in a week or two. Banks aren't designed to provide fast funding purchase money loans. They're just not anymore. The average conventional loan takes 45 days to close. Now that's not true in every situation. We have some co-hosts here like Rob Spinoza of RPM Mortgage. They've got a program that can close in 21 days. But everything has to be perfect as for you as the borrower for that to happen. And we help a lot of clients who are trying to compete with cash buyers in the Bay Area, which still comprise 25% of purchases. 25% of real estate purchases of single-family residences in the Bay Area are still done in cash. And so those cash buyers have an advantage over you if you're using financing to compete on a purchase. So what some frustrated buyers have done, they've come to Pacific Private Money with their excellent credit, cash in the bank, everything is perfect for a conventional loan, but they want to be able to make an aggressive purchase offer and close. A typical would be close in 11 to 14 days with a no contingent or low contingent purchase offer. And so that's another way where we can help. So we're now in the business as an alternative finance real estate lender of helping people compete in a very tough, aggressive marketplace. And we're here to help people who have something in their story that causes their bank or mortgage broker to say, you know what, we can't help you until you fix that one thing. Well, if they're ready to react today, they want to buy the home now, that's where we come into play.
Very good. Why don't you guys, again, one more time, give out your information.
So PacificPrivateMoney.com, PacificPrivateMoney.com. If you haven't been there in a while, go again. We're always adding content. We're working in our little studio at our office in downtown Nevada, recording new vignettes and updates, and we're talking on the drive down here to the studio today about some more stuff that we're going to work on and record. So we're adding more and more information, and if you're a fund member, be sure to go to the investor portal and take a gander at the balance sheet, profit and loss statement, and the current loan portfolio of the Pacific Private Money Fund.
Very good. Don't touch that dial. The best of investing. We'll be right back with some closing comments.
Awesome.
Okay, last segment we only have
5, right? Or 4.
You're not really
five.
building up to the answer that you're going to give.
What's that?
I always answer directly, and I could build up to it
Yeah.
and provide more kind of color around the answer I'm going to give, and that's
I have to be careful not to go down too far of a tangent, and I'm kind of good at pulling back and
you are.
okay, now with
You
that
use the
information.
you use the time well.
Yeah.
Like, how am I going to fill the rest of this?
It's good for radio. I got chastised, not recently, this was several months ago, and it was one of the calls that, it was a capital call that was set up for me. And I was kind of doing that, giving a long answer to a short question. And the guy on the other end of the line said, Mark, let me stop you. Let me give you some advice. Answer the question, then go into the detail. Don't go into the detail first. Don't give the backstory first.
Exactly.
Answer the
Yeah,
question
people
that
are
was
waiting to
asked.
hear the answer.
Yeah, right.
To the
Yeah.
question. No, he's right.
And so that was good. It was good feedback.
All right, so we got one more little segment here. What do you want to cover in the last 4 minutes? So, what's that?
Did we recap? Oh, communities. Do you want to end up on how we impact communities?
Oh yeah,
Okay.
impact investing.
Yeah.
Just a real quick. Yeah, I'll do that. Absolutely.
Here we go. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Mark Hahn and Nom Fon. And Mark, one of the things that you hear about also today is impact investing.
That's right. Yeah, the term impact investing is thrown around a lot. I hear it at some of the events we go to where investors are being shown investment opportunities. And so I've been asked, so what kind of impact does the Pacific Private Money Fund make in the local communities? And it's a great question because we've been actually kind of beating our chests, so to speak, for years about how companies like ours, companies like Pacific Private Money, who provide alternative financing for people who can't get it from banks, the good work that we've been doing in communities. And there's really two types of good works that we're doing. Number one is it was really private capital that was the catalyst for the recovery in the real estate market as we've seen it over the last 5 years. And what I mean by that is all of the contractors, remodelers, construction people, real estate investors that were buying up foreclosed properties, distressed properties, many of them in sorely in need of remodeling, buying them, remodeling them, making them turnkey for families. And what that did is it took neighborhoods that were highly distressed in areas all over the Bay Area, and it transformed homes, streets, neighborhoods, and local communities. That was done with private capital. That's not being done by the banks or the conventional lenders. They were on the sidelines in 2009, 2010, 2011, 2012. For the most part, they're still on the sidelines today in 2017. It's private capital that transformed communities and was the catalyst for the real estate recovery. That's number one. And number two would be what we were just talking about. We help people who positively need to close next week, close on real estate transactions. We give them a plan B when plan A, banks and conventional financing, is not an option. We help families get into the homes they want and need. Oftentimes they have a non-refundable deposit at risk. They're going to lose tens of thousands of dollars if they can't close next week, and their bank has said, I'm sorry, we can't accommodate your situation.
So you're not like the evil banker, you're like the good banker. So if I'm watching It's a Wonderful Life, you're
Good
more
banker.
like George Bailey rather than, Mr. Potter.
Well, it's true. It's the predatory lending practices that many people associate hard money with, and I hate that term. We do not use that in our business anymore. In fact, I think we should have a swear jar. When anybody says hard money, they got to put $1 into the swear jar. But we are not those companies are for the most part out of business. They went out of business shortly after 2008, 2009, when everything went to heck in a handbasket. And so, thanks to Dodd-Frank, we are now much more regulated. We're not as regulated as the banks, and that's actually a good thing for consumers. So we're regulated. We have higher quality deal flow. We help communities. We are positively impacting local economies here. And so if you invest with a company like Pacific Private Money, you can actually feel good that you are helping communities and you're not investing, as one of your dumb friends might say, oh, those guys are predatory lendings, you're investing with loan sharks. Well, that may have been true had you invested with a company 20 years ago, and we didn't exist 20 years ago. We were founded in 2008 to supply capital to those in need. So for more information about Pacific Private Money, like we said earlier, go to pacificprivatemoney.com or give us a call. We'd love to talk to you about your situation, whether you're a potential borrower or a potential investor. Please give us a call. We're great to talk to. 415-883-2150.
Very good. I want to thank Mark Hahn and Nom Fon of Pacific Private Money for joining me here in the studio yet again. All right. Thought for the day. Newt Rockney said, one man practicing sportsmanship is far better than 50 preaching it. I like that. And Eris Parsegan, the other coach, right, said, a good coach will make his players see what they can be rather than what they are. I like that too.
Nice.
All right, well, tune in next week to the Best of Investing because we're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long. Let me drag that out a little bit. Welcome. Wait for it. Wait for it.